All right, back by popular demand. I have Sean and Devon from Freedom 10 joining me again. We had them on a webinar, I think a few webinars last year anyway. And you guys have a lot of really interesting things to talk about. It's all around people accumulating more wealth through tax strategies, mortgage financing strategies. And we had a lot of our clients who joined us on a webinar last year reach out to you. I know you've helped them with their cash damming or Smith maneuver or different financial structures. So we'd love to have you guys back on and hear what you guys are working on. And please jump in.
Thanks, Ron. We're excited to be here. We've worked with a few of your clients primarily on rental cash damming. And what we're going to be talking about today is how rental cash damming can actually accelerate the Smith maneuver. And there are really powerful strategies available to landlords that can take you from being an everyday mom and pop landlord to a professional investor. And the idea of it is if you buy a rental property and you hold it for 30 years, it's a good investment. But when you compare that to the S&P 500, it's probably similar. But the S&P 500 has a lot less headaches. So there are certain mechanisms you can pull on with the properties you already have where you can get about 100% more profit from your current assets without increasing your budget or making any major changes other than implementing these strategies. So professional investors really use their properties differently than you do. And we're going to walk you through a map on how to get to that end result today.
Yeah, I love that. I mean, real estate to me has always been the safest and most lucrative way to build wealth. And, it's a pretty simple concept when you're buying a property, you're getting a mortgage from a bank, so you're only putting down a small percentage. You've got a tenant who is paying off that mortgage, paying the bank back, and your leverage. And over time, real estate has historically always performed incredibly well. But what you guys are doing is really interesting because you're taking those returns and you're essentially amplifying them to allow investors to be able to earn more money, to keep more money, but also to reinvest more money and double down, so to speak.
Yeah, and it really aligns with kind of how you view real estate investing, which is your rental property goes up in value and the tenant pays it down. But let's not let the equity sit there idly, right? How do we maximize that equity? And with a few small changes on where you direct your rental income, we're going to show you some really cool things that you can do rather than just keeping it within that rental property. So we're excited to dive into it.
Let's do it.
Well, we can see the screen clearly.
Yep.
Perfect. Okay. So, like I mentioned, we're going to be teaching you how to get 100% more profit from your existing portfolio. And it starts with how we structure our debt, taxes, and equity that we already have. We're going to be talking about using rental cash damming as an accelerator to the Smith maneuver. We'll touch on debt swaps and repeated equity takeouts with your rental properties. We are Freedom 10. We're made up of licensed mortgage professionals, CPAs, and financial advisor partnerships. And we really help landlords structure their debt, assets, and taxes for maximum profitability. Our job is to design and implement tax efficient strategies that allow you to really get the most out of your real estate assets. We've got 15 years of experience in the finance and mortgage industry, and most of what we do is really to prevent expensive mistakes. Devin Noble is my business partner, and so is Sergey Modilevsky. And it's important to note that we use these strategies ourselves, so we practice what we preach. This will be a 20 to 30-minute talk. We'll have some questions from Ryan throughout it. We're really going to show you the perfect system that we've designed, which is complementing these two strategies together. And then we're going to show you how we can help you do this alongside a CPA and financial advisor. And all of this is done without increasing your monthly budget. So what brought you here? You've either seen our ads or our organic content where we talk about getting 100% more profit from your current portfolio. We've also claimed that we can pay off your mortgage 10 years early, or that we can stop a cash flow negative property in the sense that you're covering it out of pocket. There's different ways that you can actually cover those losses and use them to your advantage. So most landlords are here, right? You buy a rental property, you use that rental income to make the mortgage payments on it, and you make your mortgage payments on your primary residence with your salary. This is like buying your first car. It gets you from point A to point B. It's excellent. You can drive that thing for 30 years and you're going to be in good shape at the end. But what we're going to do by the end of this is show you how professional investors set up their properties. And think of it as a high performance portfolio. So we're going to take that car and turn it into a supercar. Don't worry about the money movement here. We're going to actually walk you through each step later on. I just want you to understand start and finish. This is a map we're going to walk you through. Don't worry about the money movement sections, but you're a basic beginner landlord. We're going to show you how rental cash jamming and the Smith maneuver combined can maximize your portfolio. And there's also a bonus at the end, which aligns with how Ryan views his rental properties. We're going to be talking about understanding debt optimization, how experienced investors get more out of each property, tax efficient debt and equity use. We're going to show you the final outcome, which we view as the perfect system, combining rental cash jamming and the Smith maneuver. We're going to show you multiple realistic common examples, 3 clients we've actually set these strategies up with, and what the impact is for them. We're going to show you how you can get your personalized results. It's important to note that we only have capacity for 20 clients a month to actually do this because of the amount of work that's involved. These numbers shown today are illustrative and not guarantees. They change based on each client's situation. I'm going to show you oversimplified diagrams. Do not think that you can take a screenshot and go set this up on your own. They are designed to show you at a high level overview of what these can do for you. Now, before anyone continues watching this, it's important to note what's required so you don't waste your time. You need a primary residence with a mortgage on it. If your primary residence is free and clear and you have no need to add money to it or a mortgage to it, it's just not going to be worth it for you. You need a rental property with a mortgage. Your rental property needs to be held in your personal name. If it's in a corporation, these strategies typically don't work. Now, someone like Ryan, who has a huge portfolio, everything in corporations, we showed him last year what would happen if he added a rental property or 2. So if you are open-minded to getting a rental property in your personal name to complement your current portfolio, I would stick around. You need at least 75,000 of taxable income. The higher the income, the better. We're creating tax efficiencies here, and under 75,000, it's just not going to be that powerful. 20+ year amortization on your primary residence. Anything less than that, these strategies aren't going to have a huge impact. But if you're open to extending them, there's ways that these can be powerful. For example, we had a client with a 19-year mortgage. We extended it to 30. We ran rental cash jamming. It brought his mortgage back down to 20 years, but it freed up payment room each month, which he could contribute to his TFSAs and RSPs. We created $273,000 in retirement funds for this client without adjusting their budget. Your primary residence mortgage should be at least $350,000. The smaller it is, the less impact this has, and the cost and time to set this up just isn't worth it. These strategies are based off of this income tax folio. Rental cash jamming and the Smith maneuver have been around for 40 years, and the CRA does allow it if you follow the steps perfectly. So the real problem that most beginner landlords face, there are missed tax deductions that you don't know exist. Most accountants aren't proactive. They're not sitting down with you, analyzing your portfolios, trying to find ways to save you money. They're reactive. They claim your rental income, your expenses, and they file it. There are ways as a landlord that you can claim the interest on your primary residence. Now there's idle or misused equity. Most of you have rental properties with substantial real estate equity that is built up that you're not using. There's lack of optimization strategies like rental cash jamming, the Smith maneuver, debt swaps, and a lot of you are getting suboptimal returns. Real estate investing is challenging. It's time consuming. If you're going to do it, get the most out of it. It can be a hugely powerful asset. So the problem, this is what most people's setup looks like. You have a big primary residence with a big mortgage. This is considered bad debt because it was used for personal use. An $800,000 mortgage is going to cost you about $620,000 in wasted interest over 30 years. This is a huge missed opportunity that most landlords don't take advantage of. So the engines of change. Remember, we talked about missed tax deductions, idle or misused equity, lack of optimization strategies, and suboptimal returns. Let's think about that primary residence mortgage, that $800,000 that is essentially useless right now. A debt swap would be if you had $800,000 in savings or equities that had a low capital gains if you were to sell them, if you could pay off your mortgage today with the snap of your fingers, borrow that $800,000 back out and put it into the markets, you have the same debt, the same assets, but now your mortgage is fully tax deductible. You can do that in chunks. If you have $100,000 you want to throw at your mortgage, what rental cash jamming does is it converts that mortgage monthly over time, whereas a debt swap would do it in an instant. So most people don't have $800,000 laying around that they can pay off their mortgage. So we use tools like rental cash damming to convert your non-deductible debt. And the Smith maneuver has absolutely nothing to do with rental properties or real estate investing. But when you combine rental cash damming with it, it accelerates how fast you pay down that bad debt and gives you more time into the equities market. So these are three scenarios we're going to walk you through today of real clients we've worked with. Andy makes $88,000 a year, has a $700,000 property, a $482,000 mortgage. This is bad debt. It's on his primary residence. And he's got a $490,000 rental property with a $385,000 mortgage. He is fairly cash flow positive. Billy and Billy's spouse has a 1.5 property, $820,000 mortgage, bad debt. They have a rental property with almost negative equity, and they're losing $926 a month. This is very common right now. Sierra and Sierra's spouse has a $3 million property, $1.8 million, $1.8 million mortgage. They've got a rental property at 1.2 million with a $433,000 mortgage. They're about cash flow neutral. This also works if you have a basement apartment. You live in a duplex, a triplex, or a fourplex. So, like most people who are beginner landlords, they're going to use the rental income to make the mortgage payment on the rental and their salary to make the mortgage payment on their home. And if they do this for 20 to 30 years, their properties are going to be free and clear, which is a great strategy. But they haven't layered on anything else. Now, let's remember this map. We're going to take them from here, and we're going to do rental cash damming and the Smith maneuver. Don't worry about the movements. Just understand we're going to get them to here. Andy, in 30 years, is going to now have a $1.8 million stock portfolio on top of his fully paid off properties. It's 154% more profit compared to where his rental property is also going to be at that time. He has not spent an extra dollar monthly contributing to anything. He has also had a cash flow positive property, which allowed him to convert the bad debt quicker and give him more time in the market. It's important to note this investment is after paying off any line of credit or debt associated with it. Billy has been able to stop his cash flow negative property because we used rental cash damming to cover it with a line of credit. He had a 22.5-year amortization. It's about 54% more profit than his rental property is worth, but he spent a lot of it covering the cash flow negative property. Sierra, 30 years, they're going to have a $3.5 million stock portfolio, which is 122% more than if they just paid down their properties over the same time period. Again, zero budget increase, and they had a cash flow neutral property. We're going to dive into the rates of return, the costs, and everything else in a little bit, but this is just to show you the power of these strategies. So the Smith maneuver and rental cash damming. Some of the requirements are you need the correct mortgage and HELOC setup. A readvanceable mortgage is the main requirement. We need to redirect where your cash flow goes. It's going to go into different bank accounts. You're going to have no increase in your budget. You need the correct team structure to set this up. A Smith maneuver certified professional mortgage broker, a CPA, and a financial advisor. We're going to be paying down non-deductible debt incredibly fast. In fact, we're actually deferring paying off that mortgage to invest. So we're paying down the non-deductible debt, but we're pulling it back on a line of credit. So you're not actually paying down your mortgage on your primary residence. We're going to put that money into the markets instead. So the first engine of change is the Smith maneuver. We consider this a mortgage deferral strategy that allows you to not pay down your mortgage, but put the money into the markets instead. The idea is that you can build an investment portfolio that outperforms your borrowing costs. I'm going to walk you through a diagram on exactly how this works in the next few slides. Now, it's a powerful strategy, but it requires careful planning and execution, and it is still leveraged investing. So you need to have a commitment of time in the market. I would not do this if you're nearing retirement or you have a short window.
Now,
So
I know the Smith maneuver was named after someone from Vancouver. I read the book years ago, The Smith Maneuver. I can't remember if it was a mortgage broker or an accountant, but maybe tell us a little bit about the background because it's such a simple concept, yet people find it quite complicated for whatever reason, maybe because it's tax related or whatever. But yeah, maybe just give us a bit of background on that. That'd be great.
Yeah, so the Smith maneuver was designed by Fraser Smith in BC in the late 70s, early 80s. He was actually a financial advisor who kind of recognized that was the opportunity that most Canadians weren't seeing, which was the ability to, as Sean mentioned, defer the mortgage paydown by re-advancing each principal payment back into the equity markets, and thus over time creating that tax efficient debt that in Canada can work so well for us over time. And so, yeah, just brilliantly designed. His son Robinson now is running the national network of helping professionals kind of consistently bring this message to more and more Canadians. So, still a family business designed in the 70s and 80s, really trying to bring this process forward. It's both complicated and simple at the same time. What I mean by that is the concept is simple, implementing it is difficult because of so many different unique considerations for each individual. And the biggest consideration is there are some ways to maximize this strategy that even those who understand it at its foundational principles can do. But it's all of the nuances that can really help you extract real value out of implementing the strategy. And that's really where we come in.
Right. And is there any concern with CRA or I guess it'd be CRA challenging this? Like, is there, obviously working with professionals is going to help you get the most out of the most amount of money, but is there a right and wrong way of doing this? Like, are there potential repercussions of doing it the wrong way?
Yeah, definitely. So this is the Smith maneuver as a general principle has been challenged by the CRA multiple times, and Fraser includes a note in his book about when the CRA visited him and they spent days working and reviewing this process, and then simply left without saying anything. And so that's the best you're ever going to get from the CRA as a stamp of approval. And obviously, it's been in use for 40 years, having been looked at multiple times. Cash stemming was reviewed in the early 2000s. And as part of the update to the income tax folio that Sean mentioned earlier, they actually included a section on cash stemming, which details very specifically something we call segregation of debt. So being able to show to the CRA why you are borrowing money is critical. And a lot of the foundation of implementing these strategies correctly, not failing audits, and not losing the benefits of the strategy comes down to how you can segregate, track, and report the different purposes of why we are borrowing money. And that's really where the process goes in. So yeah, these strategies I highly recommend. They're not DIY strategies because there's so many nuances to the different scenarios. And it really does fall on the tracking for the CRA to make sure that you accomplish this correctly.
Yeah, then I know you guys have already said this, but just for the viewers, like at the simplest explanation of this is essentially you're taking debt that you already have, which is bad debt, meaning you're just paying the debt. It's not doing anything for you. It's not working for you, and turning it to good debt, which a simplified simply means that you're going to be able to write off that debt and you'll have tax savings through it.
Exactly that. Yeah, you get to count the interest towards reducing income for tax purposes, and there is no cheaper way to borrow money in Canada than that. So, where you look at a mortgage rate of 4%, for example, and if you're in the highest tax brackets, you're in Ontario, for example, you're paying over 53% on a marginal tax rate. Well, that cost of debt, if it's structured correctly, could actually be sub 2%. And it's so easy to multiply returns when you're borrowing at such cheap net effective costs. It's why everyone scrambled to borrow money when rates fell to 1 to 2% throughout the pandemic, because the leverage and the returns that you can create with that type of available borrowing costs are just substantial.
Yeah, great. Yeah, sorry to get sidetracked there. I just wanted to add some history and context to it.
No, that's great. It's a perfect time to do it. So at a high level, you're going to be making your mortgage payment, and then we're borrowing back the principal pay down portion through a line of credit. So the principal paid down the loan and the line of credit limit increased. So we're borrowing that back and we're going to deploy it into the stock market. Now there's investment eligibility requirements that you have to follow, and you're going to want to leave a little bit back in the line of credit so that it can cover its own minimum interest payment. And this stops you from actually increasing your budget by having to service that line of credit. And that HELOC that you borrowed from for investment purposes now generates tax refunds, which you can use to pay down that bad debt faster and rinse and repeat the cycle. And this is a simplified diagram where let's assume a mortgage payment is 4,000 and split between interest and principal. So the bank gets their interest, the principal pays down the mortgage balance, which opens up room on the line of credit, which we borrow. We leave enough to cover its own interest payment, and then we deploy that amount into the markets. The line of credit creates tax savings, pays down the mortgage, and we repeat this cycle. So there's many CRA guidelines that are not mentioned in this diagram. Each scenario is unique. There are certain banks that do not allow the feature here where you can borrow from its own line of credit to service the payments. They could call your loan if they catch you doing this. Manulife is really designed for this. It is the Rolls-Royce of products for running the Smith maneuver and cash damming. You need the correct bank accounts. You're going to be doing this monthly for several years, and tracking is critical.
And you guys help set up all of that. I mean, you guys are mortgage brokers, tax specialists, but you'll help them set up with the right bank at the mortgage and which
Yeah.
we'll get into, but right. Okay.
Yeah, we'll get into that. We partner with CPAs, financial advisors, and we help structure everything together so that it's compliant. So rental cash damming, we did a presentation on this last year with you, but for anyone who hasn't seen it, we'll talk through it right now. Again, like I said earlier, it is a debt conversion accelerator. We're using your rental income to pay down the non-deductible debt on your primary residence. This allows you to deploy money into the markets earlier and faster than if you just did the Smith maneuver on its own. And we're going to be using the tax refunds to pay down that non-deductible debt faster and continue repeating that cycle. Now, it can also help you cover rental losses because you're making your mortgage payments on the rental property and covering all expenses with the line of credit that's now on your house. So if your rental property is bleeding money, we're using the line of credit to cover everything. So you immediately free up capital that you were using to cover the rental loss. Again, high-level overview. Rental income towards your primary residence mortgage. That pays it down. We borrow from the line of credit, which now has room, to make the mortgage payment on the rental property. Tax refunds from that line of credit pay down the bad debt faster. And then we continue repeating this cycle. Again, high-level overview. Same thing with the Smith maneuver. You're using your regular mortgage payment to pay down your mortgage. We're then taking your rental income, and now you have two choices depending on your specific situation. You can deploy all of the rental income towards your primary residence mortgage, or you can hold back a little bit if you're anticipating paying income tax on your rental property because it's profitable. Line of credit limit grows. We borrow from that to pay the mortgage payment and other expenses on the rental. We leave enough to cover the interest costs and tax refunds. Exact same considerations as the Smith maneuver. There's more guidelines. Every scenario is unique. Some banks don't allow the HELOC, etc.
Now, what if purchasers or sorry, homeowners and someone who set up this structure, what if they sell their primary residence? Are they just simply moving the mortgage maybe from one property to the new property, or are they having to set up the whole structure over again? How complicated does it get? And selfishly, I'm asking for myself because I tend to move a lot. I want to see how it'll impact the structure.
So it depends really on who you're with, Ryan, as your lender, and then timing around kind of when you're buying, when you're selling. If you're buying and selling at the same time, as most people do when they're moving, generally speaking, it's relatively easy to move that structure across and just kind of reset up the existing structure to continue. Again, those types of scenarios are ones where the accountants really get involved just to make sure that the timing and the deductibility of the interest can continue to be tracked correctly. But moving does not limit these strategies or preclude you from considering them at all. You just want to be working with the right lenders to make that process as easy as possible.
Now, in terms of on the lending side, does anything change on the investment property that I'm not selling? Is it just the financing on the primary that I need to factor in?
Exactly correct. Financing on the primary is generally where a lot of these strategies are actually deployed from. So that's the piece that, for the most part, gets the consideration for structure.
Yeah, got it.
So this is the combination. This is the perfect system, we call it, combining Smith maneuver with rental cash damming. So again, pay down here, pay down here. You borrow to put money towards mortgage payment and expenses on the rental. The difference is now we're taking the freed up room on the HELOC and we're investing it into the stock portfolio. We're leaving enough to cover the interest. This is going up quicker, which creates more tax savings and repeats this cycle. You can do this in chunks and you can buy another investment property. But the idea is you do this monthly with the Smith maneuver. But if you want and you have equity in your property, you can also layer in taking out equity of your home to buy more rentals. You can take out equity of the rental property as it comes up for renewal. We can assess how much equity is there, what the cost would be. We'd extend it to 30 years. So you can really leverage the equity you have in both properties to create tax efficient debt and invest further. The goal is to use the rental income and your primary residence salaried income that's going towards this to pay down non-deductible debt incredibly fast. We're not increasing your payments because we're able to cover the own interest cost here. And we want to maximize your time in the market. Now, Devin talks about this all the time. There's dozens of combinations on how we can structure this debt on the type of investments you want to put your money into if you're doing the Smith maneuver. The idea is you understand the benefits of this and you work with us and financial advisors to structure all of it correctly based on your goals and your situation. So how did Andy go from this, right? He made his mortgage payments for 30 years. It was paid off. He had free and clear properties to getting a $1.8 million investment portfolio. Well, he did this for 30 years. He did the Smith maneuver and we assumed 8% annually on average in the markets. So he's waking up in 30 years with 2.6 million in the bank in his investment portfolio. He still has a line of credit balance.
To be clear, that investment portfolio wouldn't even exist if he wasn't pulling money out through this structure. Is that correct?
Exactly.
Correct.
That's essentially tax savings that he was reinvesting.
It's tax savings and the principal portion of his regular payments of the mortgage.
Yeah.
Yeah. So this guy didn't contribute to RSPs. He didn't contribute to TFSAs. He did not save anything additional. All he did was paid his mortgage for 30 years. And instead of paying it down, he used that principal portion to invest in the stock market and use rental cash damming to speed it up. So he woke up with 2.6 million. His mortgage balance is the same, but it's now on a fully tax deductible line of credit. So when we pay that off, he's got a net portfolio of 2.1. So he's actually waking up with 2.1 million. But let's be real, he had to borrow from a HELOC, so there's interest costs. It cost him 483,000, which generated 164,000 in tax refunds. So if we're actually to look at the net profitability, it's about 1.8, but he's actually waking up with 2.1 million.
Yeah, that's great. So let me just try to simplify that again. So there's kind of a side-by-side scenario for Andy. Scenario one is do what, the majority of people do, 99.9999%, and they get a mortgage, they pay off the mortgage, and in 30 years they own the property free and clear. So that's scenario one. Scenario two, what you're saying is create this mechanical structure to your mortgage mechanism, almost financial mechanism, I guess, or whatever the proper word is. And that allows you to not only get tax savings, but it's kind of forced savings. So the same scenario within 30 years is you don't just end up with your property paid off, but you end up with an additional, was that the 1.8 million?
Exactly.
Okay. So you've got your property and an extra 1.8 million in scenario two.
And all you did was redirect your cash flows and made your mortgage payments for 30 years and followed all the steps we give you. But essentially, that's what it is.
Right.
Now, we can play with different investment assumptions. Our financial advisors like 8%. They find it's middle of the road. But if you want to look at 6%, there's still a material benefit. Now, let's look at the other two people. Billy had that rental loss, right? Well, he's going to wake up in 22 and a half years with 1.9 million in the bank. He's still going to have the same mortgage balance, which is 820. So when we pay that off, he has 1.1 million in the bank. He covered his rental loss with cash jamming, and he still ended up with 1.1 million in the bank. His borrowing cost at that time was 563,000, and he got back 264. So his net benefit is 869, but he's still waking up with 1.1 million. Sierra and Sierra's spouse, they're waking up with 6 million in the bank. They have the same mortgage, but it's on a HELOC at 1.7, so the net portfolio is 4.2. Borrowing costs during this time period were 1.5 million, tax refunds 800,000. So the net benefit is 3.5 million. No budget increase, just running these two strategies. Now, some people aren't comfortable with the Smith maneuver. They aren't comfortable with the stock market. They like real estate. So what could rental cash jamming do on its own for each of these people? Andy was able to pay off his mortgage 11 and a half years early. He got back 41,000 in tax savings, which I mean isn't incredible. Saved about 100,000 in interest. But more importantly, he doesn't have to make $323,000 worth of mortgage payments for 11 and a half years. He could deploy this into the markets. He could travel the world. He could help his children. Every single person who has an investment property that's not in a corporation should be considering this.
It's awesome. Yeah, that was my next question. So say someone doesn't want to, have a mortgage for 30 years and their goal is, tax savings, but ideally to pay off a mortgage in 20 years. So that example is an example of accelerating the mortgage being paid down, but also the savings of doing it in a shorter period of time.
Yeah, yeah. Rental cash jamming helps you pay off your mortgage faster, and in its simplest concept.
Yeah.
So Billy, who had the negative cash flow property, still paid off his mortgage 3.3 years early, saving 90,000 in income taxes and about 7,000 in mortgage interest, and freed up 174,000 in mortgage payments while covering his rental loss. So if he instead invested that $900 a month, topping up TFSAs, RSPs, we could add that to this as well, but we didn't, just to keep it conservative. Sierra paid that big mortgage off 4.5 years early, almost 200,000 in tax savings, saving 82,000 in interest. More importantly, freeing up 468,000 in mortgage payments that they could do whatever they want with. So to recap, the power of rental cash jamming is that you can get out of your personal residence debt faster and retire early, pay less income tax, and free up cash flow if you have a negative cash flow property. The focus should be on long-term capital outcomes. We're focusing on wealth acceleration. More time in the market earlier will yield you a bigger result. Tax-efficient investing. As a landlord, we can convert the primary residence into a tax-efficient mortgage. We're looking at long-term stability. So we can build portfolios that perhaps mimic the S&P 500. You can do ETFs. You can work with a financial advisor to build something within your comfort level so that your risk tolerance can be matched with what's actually happening. Now, compounding capital. Rental cash jamming allows you to get into the market earlier, and over time, we know how compound interest works. And this is scalable growth. When we optimized these structures, we can more easily scale our real estate portfolios. Devon mentioned this, the risk of doing it yourself, right? You've seen some pretty simple diagrams here. Why not just go try and do it? Look at Reddit, maybe ask ChatGPT. By all means, go for it. But if you want to risk $1.8 million by messing one step up, that's up to you. You could risk commingling your debt, missing steps, getting bad advice from people who aren't good at this. There's huge penalty risks, right? If CRA audits you in 5 years and you missed a step today, all of that's getting clawed back plus interest. There's attribution rules you need to be aware of. And you can work with the wrong bank. If they catch you doing this, they could call your entire loan, not just the amount that you've borrowed from. What do we do at Freedom 10? So the
What
cost.
are the, sorry to jump in, Sean, but what are the risks of, having a professional like yourselves set it up? Are there risks to this structure?
The risk, I mean, Devon can chime in on this, but it would really be missing a step and not doing this properly.
But if everything's set up properly,
Mhm.
there's no risk. It's just a benefit for structuring it and setting it up properly. I mean, is there a risk? I mean, I guess there's always a risk if the real estate investment or the stock investment did poorly.
Yeah.
That component of it is certainly a risk. Are there any other risks that people should be aware of?
I wouldn't say a risk,
So
but sorry, Dale, let me answer this quick and then you can
yeah,
chime in. But it's really like you have to commit to doing this. There's 15 to 20 minutes a month for the next several years where you have to sit down and move money.
Yeah.
And it's leveraged investing with the Smith maneuver. So you really have to be working with your advisors to be in a balanced portfolio and understand that in down markets, you're going to be dollar cost averaging, right? It feels scary, but you're also buying as prices are going down, and you have to commit to doing this for a long period of time.
Yeah.
And
Yeah, and
Devon?
what is the optimal period of time? I mean, obviously over 20 years to pay off your mortgage, a 30-year mortgage in 20 years, it's a long period of time. Are there still benefits of doing this if someone's planning on exiting an investment property in 5 years, 6 years, 7 years?
Those timelines might be a bit tight, but if you have several rental properties and a lot of rental income, you can convert your bad debt very quickly.
Right.
That would allow for a shorter time period. But if you have one rental property, doing this in 10 years is not going to make sense.
Might not be worth the structure. So, I mean, I have a lot of mortgages. They're under holding corps. I will be planning on closing a few of my upcoming properties in my personal name to take advantage of this.
Mhm.
But if my primary mortgage is roughly $8,000 a month, a $1.9 million mortgage, if I had enough investment income, investment property debt to pay off through this structure, I essentially, and correct me if I'm wrong, but could I create a interest, essentially a tax deduction of roughly $8,000 a month? If that's a line of credit, so I'm paying about $7,000 a month in interest. Could that be purely a tax deduction to my personal income?
If you do it as a debt swap, Ryan, yes, that's exactly that's the snap of the finger move. So there are, and this has always been the case, kind of how the wealthy manage money and acquire assets, especially personal assets. So like their primary residences. We do this very often with folks in the wealthiest neighborhoods in downtown Toronto. They're buying their primary residence in cash using sale of assets or investments, and then they are refinancing those properties to redeploy those funds into the market. Same mortgage that they would have had, same investment portfolio they would have had, but now the interest costs of that loan are completely deductible against their income because they've been borrowed and then borrowed for the right reasons. So there's a lot of fantastic structure, and I think that's really what the spirit of even why the Smith maneuver was created is the wealthy have been doing this forever in Canada. It's not a new function. It's where you see the terms of the rich get richer. It's because not only are they constantly being provided this type of advice, but they have some of the mechanics to do it. Most of us don't, but we have tools like cash jamming, the Smith maneuver, to give us a bit of a leg up to kind of get to that spot.
Well, let's just use my example as a very simple example, a real example. So I'm at the highest tax bracket. I'm paying 70,000 per year, roughly 80,000 per year on my interest on my primary residence. I could be using my rental properties if they were under my name, which future ones will to be able to reduce simply and easily reduce my income by roughly 80,000 per year, which almost instantly has a $40,000 per year saving.
Exactly. Yeah, you'd be about 42,800 in rough savings
Right
a
away.
year for
For you.
something like this. Exactly.
Incredible.
Yeah,
Yeah,
and Devon,
if your income splitting, you're factoring that across two people as well. It can add up for you, right?
Yeah, and so that kind of comes into some of the rules, especially things around attribution, as there are considerations of how you are declaring the interests for cash jamming, who owns the rentals makes a huge difference. There are a lot of moving parts to that, but absolutely, that's where we want to make sure that we're tracking those correctly. We build those into the assumptions up front, so we have a better idea of what your scenario would look like compared to the next individuals.
Okay, awesome.
and just to touch on your other questions, what are the risks? If you do get audited, the reason you work with us is to prevent those expensive mistakes. We make it easy so that you know exactly what to track and how to build a package so that if you ever do get audited, you're not scrambling looking for things and spending hours dealing with that. You give them a clean package and it makes that whole process a lot easier.
Makes sense.
So what do we do at Freedom 10? Why would you work with us to help set this up? Well, first and foremost, we got to do a diagnostic. We'll jump on a quick call, answer your questions, figure things out. We'll run your numbers, and then we'll get on a video call with you to walk you through the calculators, the setup, all the considerations, and all that is complimentary. If you want to hire us to set these up for you, it's a one-time investment fee ranging from $3,500 to $12,000. It's fully tax deductible, depends on the complexity of your situation and which strategies we're doing, and if the financial advisors are involved, etc. We'll set up your strategy, whether it's with your existing bank or we're moving it to someone like Manulife, which is the Rolls Royce of products for this. We'll give you a custom debt optimization plan, which is signed off on by a CPA, saying that this structure matches what the CRA is looking for. We're going to give you up to 12 months of support. We'll meet with you every month as much as you need to help you move that money to make sure you're comfortable not missing any steps. You'll get our custom transaction log so that everything is neatly organized. We're going to do an interest deductibility debt audit, which most people don't do. Because if you did something a couple years ago and we start doing this strategy today and the CRA audits you in a year or two and they find that out, everything could be disallowed. So we make sure that it's nice and clean, and we'll give you some tax support at tax season. So we're not filing your taxes, but if your accountant has questions, we're here for answering those if needed. And then what's unique about us is we come with a money back guarantee. We stand by our work, we do these strategies ourselves, and we're going to be with you for 12 months, making sure you don't mess up any steps. And if people want to book a call with us, they can scan this QR code or visit freedom10.ca/contact, and we can get in touch with you.
That's awesome, guys. Really great stuff. I'm excited. I love being able to bring these opportunities to our clients in our database. And there's a lot of things out there that people can do, not just not just real estate investing. There's layers that allow people to do things through tax savings, through tapping into equity. So yeah, really appreciate that. That had a tremendous amount of value. I can't wait to sit down and talk about my properties that are closing. I've always closed them under a holding corp, which made a lot of sense to be able to have a lot more borrowing power. But yeah, I mean, it makes a lot of sense to start tapping into these tax savings right away. So I'm excited.
Yeah, we recommend do both, right? If you already have them in a holdco, add one in your personal name so that you can take advantage of both strategies.
Yeah, great. And how
I just
long does
want
the
to,
process typically take, guys, to set up?
Devin, what would you say? It depends on someone's
Yeah, really, it really kind
FX.
of, it mainly depends on whether or not you need to restructure the mortgage. Because if you're restructuring the mortgage, generally you're, 3 to 6 weeks, call it, for that process from start to finish. The structure set up for us, once you get in touch with us, we've got your information. The minute you give us the green light, we can have you set up structurally over the course of, 1 to 2 weeks. That bit is not that bit's not difficult, and obviously the implementation moves on a monthly basis. So as you get more and more comfortable with it, we find most of our clients by month 3 have no issues executing the strategy on their own themselves because of the automations and the process efficiencies we can help them build in.
Yeah, that's awesome. And then, so when you say structuring the mortgage, you mentioned Wealth One, Manulife a few times. So, is this possible with other lenders, where if you can just structure it the right way, or do they, people interested in doing this have to go with Wealth One?
So, it in theory, it is possible. Where you will find it to become a challenge for you as a borrower down the road is that tracking mechanism, especially when you are layering in either multiple rental properties to a cash stemming implementation, or the Smith maneuver in combination with a rental cash stemming. There are different tax considerations. There are different requirements. Say you sell the portfolio down the road, but not the rental. And so the manual tracking, the fund movement, and the just general kind of tax considerations with those are way more easily designed and segregated within the Manulife One product, which is why we stand by that as kind of the recommendation of it. It takes a lot of the work out of your hands into that product. It is possible with other lenders, but that work then sits now with you. And that's where we find most people make a lot of the mistakes. So we try to prevent the problems that most individuals don't see coming. We do, just because of how long we've been implementing these for people.
And that work that falls on the individual, that's like a monthly reconciliation type thing to make sure that everything's tracked properly. Is that?
Yeah, exactly. The monthly reconciliation, there is quite a bit of math to that, especially as you start to work into bigger numbers, when you're blending multiple strategies or multiple properties
Right. And then
together.
with the amortization, I imagine also plays into it.
Yeah, exactly. As does the number of bank accounts that you would need if you're trying to do this with a lender that doesn't necessarily have the same tracking capabilities, or not even the same product capabilities, meaning what they can do with their readvanceable mortgage product. You could be heavily limited to that. And it could be, a difference from 2 or 3 bank accounts to 10 bank accounts. And so it really does double down the work.
Okay, great. And if someone wants to get a line of credit or a mortgage through Wealth One, are you guys able to help them with that?
Yeah, absolutely. So we do a ton of business with Manulife in the Manulife One product, but we are just general mortgage brokers as well. So we have access to all of the lenders that mortgage brokers do, including several that other brokers don't, National Bank, BMO. So absolutely, yeah, we have a wealth of different lending options. Many of them can be accommodated for these.
Okay, and financing with Wealth One, I mean, I think Manulife's considered a B lender. Are the rates typically a little bit higher than if someone were to do this through TD or a RBC?
So Manulife is so there's actually two lenders. Wealth One is actually a B lender.
Yeah,
They're a separate entity. Manulife has their Manulife One product.
got it.
They are a lender. The rates would be comparable to the banks. Sometimes there's a small premium on the rate, but it really does come down to the fact that it is really the Rolls Royce of mortgage products for these strategies.
And keep in mind, Ryan, your mortgage is actually only in that rate for a couple or several years until it's fully converted to the line of credit. And then the line of credit rate is equal to any bank. So you're actually really only in your mortgage for about a term. And then it's in the line of credit. So it doesn't really matter because it's all tax deductible debt anyway.
Got it.
I just want to quickly show you an example of a client we worked with yesterday that has exceptional results. And I think it represents a lot of Canadians. This is a couple. They are in their early 30s. He makes about 120. She makes about 65. They have a home that's, what is it? It's worth 850,000. They have a mortgage worth 540,000. They have a rental property that's worth around 500,000 and it's fairly cash flow positive. So they're going to wake up in 30 years with 3.7 million in the bank. They're still going to have a $540,000 mortgage, but it's a line of credit now. So their net growth is $3.2 million. These people have one rental property and modest mortgage amounts and modest income. So this is how powerful combining these two strategies could be for the average Canadian if done properly.
Yeah, that's compelling.
Yeah.
All right, great stuff, guys. I appreciate it as always. Anyone watching this, you guys should reach out. These guys are some smart guys and they're going to save you some money and make you a little bit more. So appreciate it as always, guys.
You as well. Thanks, Ryan. Thanks.